I can't believe the HODL Factory is already over 2.5 years old. It's been an incredible ride. We've learned a ton along the way, and the results speak for themselves. Since inception, this portfolio has outperformed VU, VT, and even Berkshire Hathaway. In this video, I'm going to walk you through the performance, what's driving it, and what we've changed along the way. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please tap that like button, subscribe if you haven't already, and consider joining the channel membership. It keeps this section short and sweet. You know what time it is. Let's grow. The HODL Factory. If you've been around the channel, you know I'm a huge advocate of passively managed ETF investing, and that hasn't changed. At the same time, I'm a dangerous combination of an avid reader and a math nerd, and I've spent years studying what successful long-term investors do. I wanted to see if I could combine the simplicity of passive ETFs with some of those ideas in a disciplined, rules-based manner. My best friend Hutch and I built a set of rules and launched what we jokingly called our own ETF, dubbed the HODL Factory, back in April of 2023. And somehow mixing all this together worked. Performance. We now have the ability to view our time-weighted returns for the HODL Factory directly inside of M1 Finance, and this is huge. Time-weighted returns allows us to compare our total returns directly against the total return of any ticker, while completely ignoring cash flows in and out of the fund. It allows us to evaluate the performance of the portfolio itself and not the timing of the contributions. This is the same method used to compare investors like Warren Buffett against the S&P 500 over long periods of time. It's the cleanest, most honest way to judge results. I used to focus more on money-weighted returns, and those still do have a place. Money-weighted returns are a great way to understand your personal experience as an investor and how your specific contributions affected your performance over time. But when it comes to comparing true performance, fund versus fund, strategy versus strategy, or us versus Buffett, time-weighted return is the gold standard. Going forward, this is the metric we're going to use. And you already know that your boy took the time to extract the total returns from all of our favorite tickers to see how the HODL Factory stacked up. We were blown away by the data. We'll begin out here directly on M1 Finance, where I actually do the investing for the HODL Factory. I do have an M1 Finance referral link as well. I'll put it in the pinned comment. I don't promote that one as much, but a few of you have used it, and it does hook you and me up potentially with usually $75 on a promotion for opening a new account. But where we're going to live here, we're going to dive right into performance of this thing and this view benchmarks right here. And it brings us out here, and right now the duration is set to all. And what I've done is I put in the competition I would like to compete against over the years, and that's VT, overall stock market for the whole world, VU, the S&P 500, and Berk.B, Mr. Warren Buffett himself. Well, as of recently, it's actually Greg Abel, but it's been Buffett for years, and this has been a fun one to follow, and it's performed extraordinarily well over his career. But when we were set to all, you can see it starts here at April, and it gives you the total time-weighted return. This aligns perfectly with total return for any duration in Seeking Alpha. And yes, I took the time to export this. You can download day-by-day results, and I tried a bunch of funky date ranges just to see if I could find some errors in the data, because that's just how I'm wired. I'm just weird like that, and it is to the decimal perfect to total returns in Seeking Alpha. I'll run you through this real quickly, but then we're going to jump out to a spreadsheet that I made to nerd out a little more. You can see on the full time duration here that the HODL Factory is up 87.39%, and VT is up about 65%, so we've outdone that one by over 20%. And then the S&P 500 is up nearly 75%. We're comfortably ahead of that by about 12%. And then Berkshire's struggled a little bit here, up 56%, but I'm sure it'll turn it around. And before I get too nerdy in the numbers, let's just pop out to the spreadsheet so I can show you more. Okay, we're out on my HODL stats spreadsheet. And I should mention that this is available for free in the description below, so you can track my performance each and every week I provide an update. I'm recording this video on Sunday, January 11th, and my last update was Friday, 1/9, as always. But a lot of this is new if you've been following me for a while, and it's so much better. So what I took the time to do is I pulled up most of our favorite tickers and all of their results year by year versus the HODL Factory. An important note, data starts from 4/14 for the year 2023. This is just the time the HODL Factory was in existence. These percentages will not directly line up with the entirety of 23 if you look out there on a total returns. So be aware of this date range. I have checked every one versus Seeking Alpha, and every single one of these is accurate. And I'm not going to run through everything here because that would take a while, but on the overall scorecard, you can see that our favorite growth ETFs, I mean, this is a little bit of a duh statement, have crushed the market, and VTI and VT and even Berkshire and all the dividend ETFs. And of course, they've crushed us as well because we're poised to be roughly market-like from a holdings and sector perspective. That said, we have outperformed every single benchmark that I do compare the HODL Factory to. That's great. And these growths, they'll probably see a reversion to the mean. Maybe they'll keep going to the moon. But as far as Hutch and I are concerned, we have done what we set out to do. And you'll notice these numbers stopped updating at the end of 2025. What we have up here is specific performance against the true competition that we're using. And it's year by year. You can see the HODL Factory won in 2023. VU took the crown in 24. In 2025, it was VT reigning supreme. And so far, 2026 year to date, pretty early. The HODL's off to a blazing start, and VT's looking solid as well. And then overall, we're 87%. And we just saw that in One Finance, the numbers match. And they also match, because I can use these ones in Seeking Alpha for the exact date range of 4/14 through the date I updated it. And I will tell you they're perfect to the 100th of a percentage. VU is 75%, so we're outperforming it by 12, and VT is 64.6, and Berk.B is 56.09. It's been a rough one. So I just wanted to show the snapshot of the performance and how happy I am with our overall time-weighted returns versus the total returns of other ETFs. And up here, I just like to show some high level metrics. We won't get into all this. You can look anytime, or you can pause the video and look. Shows the dividend CAGRs, the yield, some return results, and a PE ratio. One thing I will specify with a little time here is we like our PE ratio to come at a nice value. We prefer to be under the market, and right now VU's over 29. That's very high. And we're still pretty high historically, but well below the market at 23.3. So we're very happy with our positioning. And this spreadsheet also has details on our entire holdings, which we'll get into in Snowball Analytics in the next section, and some more high-level metrics. Like, look at our net income margin, 27% on average. This is what long-term returns tends to trend towards. There's a lot of noise in there, as many know, but this is a very important metric in the last 100+ years of the market. So feel free to bounce out to the spreadsheet anytime, updated weekly, to see how the HODL factor is going. And if you're following along, you have that specific holdings that I showed you on the other tab. Now for some insight on how Hutch and I are managing this thing. Portfolio changes. We had our quarterly meeting in late September, and overall, things were pretty steady for the HODL Factory. There wasn't a long list of moves this quarter, just one. Let me show you that single change we made to the holdings and walk you through the thinking behind it. And before we dive into the specific change of holdings this quarter, we had to pop out to Snowball Analytics, where I tracked this HODL Factory very specifically against the market and other tickers. And again, it's money-weighted returns, which isn't my favorite, but we will dive into that a little. And you can try Snowball Analytics for absolutely free if you are interested in tracking your portfolio performance. It really is the best I've found. All the screens show total return. We're going to walk through some things right now, but it's a reasonable price, and I have a link that'll save you additional money in the pinned comment if you want to get out there, try it for free, and if you like what you see, just keep it rolling. But I'm going to give you a free preview now before we even get that far. So starting out on the home page, the dashboard here, we can see the value of the HODL Factory and how much of that is invested. And a lot of that is dividends, of course. The total profit which is realized, unrealized, and dividends. And then the internal rate of return. This is just your annualized return. So 20.4 since inception, not too bad for overall. This includes sold positions. You can see it's 16.5 on the current holdings. And then our yield is 1.34% with a dividend growth rate that looks very low, actually. I don't think this is correct at 14.6%. And that's good for $460 annually. But one thing I love about this main dashboard is seeing the sector breakdown. It's like looking up the holdings tab on Seeking Alpha for an ETF, but it does it for your holdings, and this is just phenomenal. You can see that information technology is up 39% on our 5 companies that we currently hold, and the allocation is 25.24% of the portfolio, and then industrials make up 20%. Financials coming in at 19%. You have consumer discretionary almost 16%. Energy at 9%. There should be, healthcare at 5% and communications at 5%. We'll get more into that. But one thing I love about this specific module is you can click information technology or any of them, and it will show the specific companies you have in the allocation. It's like seeing the subsectors within a sector. It's really, really cool. But the next place I want to take us is out here on diversification. And to be fair, this is more of the quote unquote holding tab in Seeking Alpha. You can see by position. We keep them at 5%. We rebalance quarterly. So this doesn't surprise me since we recently had a quarter. And I just realized I said in late September. It was actually late December, our last update. Wow. I don't know why I did that earlier on when I was on screen. And then it shows by sector as well. So this is like your Seeking Alpha view. But now we're coming out to the dividends tab. And this is why so many people love Snowball. You can see our yield on cost, and the dividends annually and monthly. And then it shows the dividend yield and yield on cost for each and every position here. But this one right here, I really like. Passive income diversification. Our positions are all about 5% of our portfolio. We just saw that. But you can see 14% of our income comes from EOG. And then Nexstar is right there at 13.1. And AGM at 12, and then Devon Energy at 9.5. And then you have these low yielders, the bank, KLA, MasterCard. I'm sure Visa's around here somewhere. Monolithic Power Systems. So these just show the high yielders versus the low yielders on the income diversification. If you want to get more income or if you want to get more growth in there. And then the annual growth just shows by company, the dividend growth rates. That's pretty cool to see. Your future payments and your monthly, it'll show we're here in January, so some of them have been paid already. And now I came out to the growth tab to just take a look at this before we get out of here. I have VOO and VT pulled up as the competition. These numbers, again, they're money weighted, and I've had a contribution, so they won't match exactly what we just saw in the year to date on the spreadsheet, but they're very, very close because I haven't contributed much. You can see we're up 5.32% to the market, VOO's 1.78 and VT's 2.5. So we've done very well here in early 26. But really, we're here to look at the fourth quarter of 2025. And in that time, we were, basically tied with the market and just behind VT. That's very close. Look at this at the end. That's wild. And then looking at these results for 2025 by month, you can see that we've been really good lately in December and November, but we had a rough October that got us behind the 8 ball. So we have very good momentum heading into the new year. And you can see here in 2026, there's just one big one that is carried over. But we're just really happy with this performance so far. All right, I'm popping out to our official HODL Factory scoring spreadsheet and methodology. I do not share this one with the public, but we'll give you an insider view here. And you can see that, spoiler alert, Caterpillar CAT ranked outside of the top 100. And just for context, if something misses the screen, it's out no matter what. If something drops outside the top 100, there's some discretion and steps that we have to take and a couple spots, and maybe I'll show you that just for us to make a human gut call. We can put them on probation too, but we ended up dropping CAT and picking up MLI. And you know what? Let's just share this process. It's still not showing the scoring tab because I have a tab that has all the logic and formulas baked in, and that's the one I want to keep between Hutch and I for now. But what we do on a quarterly basis, if we have something like CAT that missed the top 100, then we put it on this, it's called the eligible tab. And this is the one we're considering dropping. And we just have some high level key metrics. This is not the scoring system itself, but it shows some things we care about. And then this rank is derived from the scoring tab on a different one. And so we have sector caps in place, and we have 20% for every sector except for technology is 25 and energy is 10 on our caps. Everything else is a max of 20. And so we have to look and make sure they're eligible. And I go through and do all that work. Actually, a formula does it for me, and it spits out the top 10 options that we could invest in by rank that we're not currently hard capped on. And we would look through all these, and I won't waste too much more of your time, but after reviewing the key metric data and the ranks, we ended up liking ticker symbol MLI more than the same sector CAT for, well, I think kind of obvious reasons. And so far it's paid off as a pretty good move. So ultimately, I'm going to jump over to our new stats page. CAT was changed to MLI here, and this just shows our new portfolio key metrics. And we actually use this to make the decision as well. You can see our 3 and 5 year dividend CAGR are 20% each. Yields 1.36. That's about what Snowball showed. Net income, there's that 27.5. Since I just did this recently, they're still pretty accurate to like what's going on right now. And then the PE ratio at the time, a little lower for both. And I should mention, here's VU stats, and here's the HODL Factory at 28 for the market at the time and 22.6 for the HODL. So adding MLI was very good for our PE ratio and key metrics. And this right here just shows our percentage lead over VU on each of these key stats that we assess. We like to stay ahead on all of these stats. The trailing returns here are mostly irrelevant. That's just for context and for informational purposes because that's past performance. But we do like to make sure our key metrics of current figures are looking good compared to the market. And I would say we get a lot of amazing stats at a 20% value discount. So I will take it. And then by sector, you can see up here, we're 25% technology. That's what we capped that at. Financials and industrials are capped. Energy is capped and everything else is not capped. It's just only that many companies made it. So this right here is the new tickers of the HODL Factory. And again, the public HODL stats is out there and I update it every week if you want to keep up. Oh, there's so many more nerdy tabs to show, but this is the last one I feel comfortable showing. So this is every company over here that we've ever owned in the HODL Factory. Now I have them filtered to the current ones because I filtered on current sector weighting. There's a bunch of zeros. I can tell you we have owned 60 different tickers over the years. We did a lot of experimenting, especially early. You see 25 drops here. We decided, and it was low money at this point, but we held, and then made a bunch of core changes and things have moved around a bunch. But I will say we have been fairly consistent with our methodology. We only sold 1, 4, 0, 7, and 5 of these were because we went from 25 companies to 20, but 7 and then 2 and then 1 as far as drops and adds for each quarter. So it's been a fairly stable, low turnover. I can tell you our long-term capital gains rate is about 90% to our short-term of 10. So that's phenomenal if you want to assess on like taxes and turnover. We're very good compared to most investments you can make. And about 200 companies with our new methodology that we changed about here, it looks like, make the screen. And that's when they have to meet all the criteria. And then we rack and stack them. You have to be in the top 100 to be held unless you're on probation. And here's just our by sector. You can see in the early stages, we were not very balanced. And that's something we slowly learned over time. So we love our sector, subsector, PE ratio, and balance of the overall system. And I think it will fare well in all markets. We should beat growth in value markets, and we should beat value in growth markets. And so far, that has been the case. We're feeling great about both the portfolio and the methodology heading into 2026. Closing thoughts. The HODL Factory is the most exciting form of investing that I do, easily. I'm genuinely excited to see whether our rules-based methodology can continue to outperform the market over long periods of time. Making small, incremental adjustments to the formula scratches that itch for this math nerd, and it gives me ownership in both the decisions and the results. That said, it's important to keep this in perspective. The HODL Factory makes up about 2% of my overall portfolio. For most people, I think that's the right approach. Keep the dollar amount relatively small if you're building something like this or following alongside the HODL Factory. Most of our money should be in passively managed ETFs with long, proven track records. Now, if we keep beating the market for another decade, maybe we can talk about going all in. And speaking of the big dogs going all in, I'd like to give a huge shout out to my now 33 incredible channel members. And a special thanks to Roberto and Meta Oracle for joining the community. We are small, but we are mighty. And I appreciate your support. It really does make these videos more viable and more fun. And one last shout out to Snowball Analytics, which I use to track the HODL Factory with amazing accuracy and a lot of cool little data points. So if you're serious about building your own portfolio and you want to know how you actually perform against the market or certain ETFs, not just what the default Fidelity and E-Trade shows you, but more juicy details, I highly recommend trying it for free. If you like what you see, sign up and hook up this bum. And last thing, check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.